But if you look at implied volatility in Apple, it's exploded. So you've got it's okay.
Okay.
You've got 38% front. I'm sorry, 36% front month implied vol in Apple. It was down to like I want to say it was down to almost 23 the other day. So what you're seeing is the inverse of what you generally see with individual indexes. When stocks go down, volatility expands. What you're seeing now at Apple, which gives a lot of arguments of my whole discussion with individual equities. When Apple goes down, you're going to see volatility get crushed. But as Apple goes up, volatility is expanding.
That's right.
Can you throw that chart up one more time? When and hear me out on this, because
and to go back to volume, IWM is traded almost 10 million shares right now. Just to put everything in perspective, IWM is the ETF.
Yeah, but IWM is a $70 stock. $80
yeah,
stock.
It's a Russell 2000.
I know, but it's an $80 stock.
Sure.
This is 6 times the size. Think of how much capital's gone through this.
Good point.
You're talking $450 billion. I mean, it's a crazy number. All right, but if you look at what I want to say is, if you look at the implied volatility in the stock, the implied volatility is expanded as the stock's gone higher, which is what happens in stocks like Apple when all of a sudden the risk is upside risk, not downside risk. So you've got a very different situation today in Apple than you have when the markets go down, volatility expands. When Apple goes up, volatility expands. But if Apple is your new market, all of a sudden that confuses people. So I bring that up. Also, interesting thing is that February has higher volatility than implied volatility than March and April. So the marketplace is confused by Apple right now.
Well, February's only got 2 days left.
Whatever, I know.
I mean, you might think
Whatever,
that.
but it's usually lower.
That's true.
There's usually a contraction in the front month.
True.
Okay. It's really interesting to look at. The next thing you look at is volume and individual option volume, because you want to know how much derivatives are trading in order to get a clear picture of what what everybody's doing. So the most popular, generally speaking, the most active single product is the at-the-money straddle, okay, in the spiders. So, Tony, if you go to the at-the-money straddle right now in the spiders.
Sure.
Listen, I want people
in
to
March
understand.
or in February?
February. I want you to understand what capitulation is all about. So the at-the-money straddle of the spiders is what?
Volume-wise?
Volume-wise.
43,000 contracts total on the 35 line.
43,000 contracts of the spider, which is the S&P 500, which is $135 stock. So it's 1/4 the size of Apple. 1/4.
That's correct.
Okay, and what's traded 40,000?
43,000.
43,000. In Apple, the 15 puts and the 20 calls.
The 515 puts in the 5.
The 515 puts and the 520 calls have traded 40,000 contracts. It's 4 times bigger.
Right.
Okay? The spiders are 1/4 the size.
Right.
And the spiders have penny-wide strikes. This has $5 wide strikes. 40,000 contracts in the first hour.
That's correct.
Okay, that's almost like record. I should say I don't know if it's record notional volume, but it's pretty close. Go put that chart back up.
Sure is a lot.
So what you have now in Apple is this is class. You're not going to see this. The only reason I'm doing this is because I don't think you're ever going to see this again, not for a long time. So you have virtually almost record volume. Then you have almost first hour record. You have first hour option volume, which is out of control.
Out of control.
Okay, but I mean these are big numbers for the day. Not even just for the first hour.
There's a lot of speculation going on and not too much investing.
Well, that's okay. And you have a jump up in implied volatility, plenty of liquidity. I understand why everybody's trading here. But now you think about this and you're like, okay, I got all this stuff. It's cool.
Yep.
So now what kind of positions? Let's just say, okay, I'm buying into this, and we're not going to trade Apple. We have a position on Apple. I don't ever add to bad positions. So I'm not touching Apple from a long-term position here. But let's just say you want to do something today. One of the things that you don't want to do, and I just want to, if you thought Apple was going down, okay? And let's say you thought Apple was going to go to 500, which is a drop of $20 from where it's currently trading.
In February?
In February. Or it doesn't matter, February, March, whatever it is. One of the things you don't want to do is, because you've seen something that you don't normally see, which is a rise in volatility as the stock goes higher. One of the things you don't want to do here is buy puts, even if the stock's going down, because if you buy puts and the stock goes down, volatility is going to contract.
I know, but people don't understand that.
I know, that's why I'm bringing it up.
The puts are going to act just like calls typically act.
To the upside.
To the upside.
So when markets make a bottom and you buy calls, it's hard to make money because as the market goes higher, volatility contracts and the calls go down in value, at least the first move. Apple's going higher. If you buy puts in here now and the stock goes down, okay, volatility is going to contract and the puts aren't going to go anywhere unless the stock moves like $10 or $20.
Right.
I mean, the initial move will be pretty big, but then it'll quickly evaporate. You'll have to be very nimble.
Correct.
So it becomes difficult to buy February or March puts. It becomes difficult to trade kind of the weekly puts because there's too much risk of volatility contraction, which you normally don't see to the downside, but you will see in Apple, and that confuses people.
Do you look at the volatility in the back months like April, May, and July and those kinds of things, not having, I mean, what they're showing you is a linear volatility. They're saying that, vol's not going to go any higher. It's not going to go any lower as time goes by. Usually you see like a little bit of uptick in volatility. Do you look into that as anything?
No.
So really what the marketplace is saying is the volatility that Apple has now, it's not going to expand. It's not going to continue.
They're saying it's probably not going to expand much. Apple's at a certain point where 33% volatility
is about all you're going to get. Because if you're not getting
based on the VIX is about all you're going to get. Exactly what they're saying. Mm-hmm. But let's look at some other things now from stuff that we've learned. So now we know volatility is going to contract to the downside. Next thing I want to look at in there is let's look at some of the statistics of getting to certain levels.
Okay.
So right now, if you look at the 500 level by February, the chances of getting there are less than 10%.
Okay.
If you look at the 510 level, the chance of getting there are 25% by February, which is today, tomorrow, and 3 days. Okay. If you
which is surprising because we were there 3 days ago.
2 days ago, yesterday.
Yeah.
Maybe 3 days ago.
500.
I'm talking about 510.
Okay, well, 500. 500, we were there on the 12th, which was 3 days ago.
We closed last night at 509. Here's the fascinating thing. We closed last night at 509. The statistical chance of getting back to 510 by the end of this week, in the next 2.5 days, is about 50%, touching that level.
Is about 50?
50.
On the 510 line.
54%.
That's correct.
54%.
That's correct.
Okay.
Give or take a percent.
It's so interesting to me now because if you were going to expect us to get to the 510 level, the 510 level, the puts are $2.50 if you were to buy the puts. If you thought we were getting to 510, you wouldn't spend $2.50 for the 10 puts. You'd buy the 15 puts at $4.15. But here's the problem with it. It doesn't make any sense to buy the 4.15 puts for $4.15 because if we get to 510, you're only making $1.
That's right.
Minus whatever premiums associated with it left in the last couple of days. So you have to be really careful here. And what you want to do is if you want to play Apple to the downside, you have to buy big, wide put spreads. If you're buying March put spreads, you have to buy $10, $15, $20, $5, $10, $15, or $20 wide put spreads. If you're doing February, you've really got to go at the money or in the money because otherwise it's just be impossible to make money on a down move.
Correct. By the way, the options are priced. You're 100% correct. 510 doesn't seem far-fetched to me with the stock is up $10 saying that there's a 50% chance.
Far-fetched? I thought it could be there in 30 seconds. But statistically speaking, you can't argue it.
I agree. But 500 only being 10% getting there and 20% of touching it, that seems, I would think that number would be a lot greater when the stock was there 3 days ago.
You would think.
You would think.
But it's not trading that way. And the reason it's not, the problem that traders have right now is if you're making a market in there, you've been run over. Listen, if I was making a market there, I'd be out of business. I'd be out of business because I would have given it to you already. There can't be a professional market maker at this point that isn't giant short Apple.
Right.
Nobody's selling anything. Everybody's buying everything from them. Okay, there's no number out there. The reason you know that professionals are short Apple right here is because they have to raise volatility to a level where they're comfortable selling it.
That's right.
So here's how it works. If you want to buy stuff, like you want to buy these coins, if I have 5 coins for sale, okay, and let's say I'm selling 5 coins for a total of $1. Once you buy those and you want to buy 5 more, the reason I can charge more money for them is because, so I already sold you 5 coins for $1. Now I'm going to come back, I'm going to sell you 5 more coins, but because you want to buy more than 5, but now I have to charge you $1.10. So I have to raise volatility by 10% in order to get to a price where I'm comfortable selling you 5 more.
Right.
Now,
because I'm comfortable taking that risk.
that's right. Now, because this move's parabolic, what's essentially happened is you've come back and said, I want to buy another 5. So now the next 5, okay, I got to charge you 10% more in volatility because I have to create the inventory myself.
Right.
And I'm already down money.
Right.
So now the next 5 up here, I sell these now for for $1.25. Okay, so now I'm up to. I started $1, then I went to $1.10. Now I'm up to $1.25.
Right.
This is very difficult to do from a trader side. So when you see volatility pop to the upside, traders are all short.
100%.
Just like Tom Busby said, all traders are short this stock right here. This becomes, who's the last one to cover and blah, blah, blah. The individual investor has had a nice run. And there's just a lot of little things in there to point out. Like, again, just to recap this, we wouldn't be buying puts here. You have to buy put spreads because of the pop in volatility. You buy puts, stock goes down just a little bit, you're still going to get killed.
Correct.
Right? You can't buy calls here because the volatility is way too rich. Of course, the stock moves $10 a day, it doesn't matter. But given where the volatility is trading there, you have to buy call spreads. Same thing. Given the option volume, given the stock volume, and given what looks like to be capitulating volatility, it just tells a really interesting story.